Hi, Robert Schein here, HighTower partner and managing director of HighTower Palm Desert. Today's topic, we're going to talk about something that's really very important in the headlines. In fact, it's moving the market over the last couple of weeks, and that's interest rates, the Fed yield curve. We wrote a commentary on it. We want you to read all about it. But essentially, we're talking about the Federal Reserve. And most recently, President Trump said that the Federal Reserve has gone crazy or loco in his words. And what does he mean? He means that interest rate policy set by the Federal Reserve, or short-term interest rates, they're raising them quickly. Now, it's not a surprise. They've been doing it all year. In fact, they said that they'd do it last year. They're doing it this year. They're going to continue to do it next year. And they're doing that because they want to normalize the yield curve or bring short-term interest rates higher. So what's important about that is, as our short-term interest rates, or our 2-year treasuries here and our 10-year treasuries here, this is a normal yield curve. But as interest rates rise slowly, little by little, and that's what the Federal Reserve is doing, and they're telling us they're doing this. This is not a secret. They're going to do it again in December. They're raising them. And it's getting close to what's called, in our financial terms, a flat yield curve, where the 10-year treasury and the 2-year treasury are getting close to each other. The key here is we got to worry about an inverted yield curve, where interest rates go up a little bit higher than the long-term interest rates. Because if long-term, like a 10-year or even a 30-year interest rate, if they don't move, that's signaling to us in the financial world that there's something on the horizon, possible recession in 2019. And so we have strong corporate earnings right now. We have lowest unemployment rate that we've seen in decades. We have the highest stock market we've ever had. So all of the backdrop is very positive. And that's where the Federal Reserve seems to have sort of the confidence to know the economy can take the rising of short-term interest rates. The problem is, since 1960, every single recession that has happened, the Federal Reserve has gone too far. Okay, so they've raised it too quickly and too much. So 7 of the last recessions that we've seen since 1960 have been just that, an inverted yield curve. So we got to keep our eye on the short-term U.S. Treasury. Basically, it's the 2s and the 10s and their connection, and we watch that on our side. But most important, the backdrop overall, the corporate earnings are strong. We just finished our 3rd quarter, so we're in earnings season right now. So we're going to keep an eye on that, and that was the 2nd quarter this year and the 3rd quarter this year for corporate earnings are all-time highs. So we want to make certain that growth here in the U.S. continues, and that's because we had our tax cuts earlier last year, late last year, that is now working its way into the economy this year. And we want to make certain that we keep an eye on trade talks that are ongoing. There are wins along the way, but there are some concerns. But also another concern that we're keeping an eye on is the slowing of the economies around the world, so China specifically and a few others. So we're keeping an eye on that for our clients. Stay connected. We'll give you more updates, but thank you for listening.